To understand how central banks work, it is essential that we understand how banks work, and in particular how they create money. However, many popular textbooks and YouTube videos teach this using the money multiplier theory. There is just one tiny little problem with this, and that is that this money multiplier is a myth. In this video, I will tell you why, and I will also explain how banks do in fact create money. So, the mythical money multiplier theory goes like this. Banks create money through something called fractional reserve banking. Fractional reserve banking means that every bank is required to hold a fraction of the money they receive from people in reserve at the central bank. The rest of the money, banks are free to lend out to other people. Then, these other people will deposit that money at another bank. And this bank also has to hold a fraction of the money at the central bank. And it can lend out the rest. And so this process repeats itself until there's no more money left to be lent out. Following the logic of this story, banks can only create a multiple of the original cash created by the central bank. I do understand that this story sounds compelling. It's a bit abstract, but it has a certain logic to it. The problem with this story is that researchers that work with banks and money directly have produced compelling evidence that contradicts the money multiplier. As a consequence, top economists and central bankers have long moved on and are no longer using the money multiplier story. Sadly, educational textbooks and videos often lag a bit behind developments in economic research. Hence, this story is still being told in multiple prominent textbooks and even in some very popular YouTube videos. So, what is the real story that is being rolled out by state-of-the-art textbooks such as the new and free Core Economics book that was produced by leading economists in the UK? This is also the story that has been largely adopted by the central banking world. This story starts out just as the money multiplier myth. Banks do indeed create money when they give out loans, but the factual story is much more simple than a money multiplier story. So, how does that work? Well, a customer goes to the bank to request a loan. When the bank approves it, two things will be recorded. The first is that the customer owes the bank a certain amount of money due to be paid back at a certain time and at a certain interest rate. Second is that the bank owes its customers the same exact amount of money, but the customer can retrieve this money on demand. Did you hear something strange in what I just said? A bank borrows from a customer, and a customer borrows from a bank. This happens at the same time. Just think about that for a moment. So, when lending to a customer, a bank will simultaneously record that the customer owes it money and that it owes the customer money. Simple, but also a bit complicated. Why would both parties agree to this? Well, let's try to put yourself into the mind of the customer. Why would you agree to this deal? You have to repay the bank far into the future, and the bank has to repay you on demand. That means whenever you want. All you need to do is to go to an ATM and exchange what is recorded in your bank account to cold hard cash. What's more, the debt the bank has to you can be used as money. So, you can use your bank account to pay other people. This is why economists say that banks have the power to create money, because you can use their debt to buy anything you want. Now, if you put it like that, it actually sounds like a bad deal for the bank and a good deal for you. Probably not what you expected when you learned that banks have the power to create money. So what is the catch? The catch is that you have to pay for the privilege. You pay the bank more than it pays you. The interest rate on loans is higher than the interest rate on bank accounts. As long as enough customers will repay their loans, it is profitable for the bank to create loans like this. So, it is in the bank's interest to create money by lending to customers. And that is exactly what banks love to do. In fact, commercial banks have created so much debt and money that in most modern economies, money created by commercial banks is by far the biggest share of all the money in the economy. This wasn't always the case. Just after the Second World War, cash and money only accounted for about half of the money supply. So, let's go over the two most important differences with the money multiplier story. The first is about the order of events, and the second is about what constrains money creation. The first difference is all about timing. If we believe the money multiplier myth, the timing is as follows. Step 1. The central bank creates cash, which then ends up in the economy. Step 2. People bring cash to the bank. Step 3. Banks keep a fraction of that cash at the central bank and lend out the rest. This is the money creation part. Step 4. This will happen again and again till it is no longer possible. Now, contrast this to the timing of the actual money creation story. Step 1. A customer goes to the bank for a loan. Step 2. The customer and bank both issue a debt. The debt the bank has issued is newly created money. Step 3. The customer will use this to make payments. Alternatively, the customer can go to the ATM to convert bank money into cash. This is facilitated by the central bank, which will lend money out to the bank, provided that the bank has made prudent loans. The money multiplier story starts with the central bank creating cash and someone bringing that to a bank. In real life, no initial central bank money is needed for loans to be created. That is a clear difference. So, does that mean that central bank money or reserves don't matter at all? Well, that brings us to the second difference. The second difference is all about what keeps banks from creating unlimited money. The money multiplier story is very clear on this. The total amount of money is constricted by the reserve requirement, which is set by the central bank. There is just one tiny problem with this. Reserve requirements do not constrain money creation. The most important reason why reserve requirements do not matter is because almost all central banks have a policy in place that facilitates reserve creation on demand. What do I mean by that? It means that if a bank goes to the central bank and asks it, can I have some more reserves? The central bank will almost always just create them and lend them to that bank. So yeah, as you can imagine, that kind of does away with this reserve requirement limit on money creation. If central banks create more money on demand, then banks will ask for more if they are ever at risk of hitting the reserve requirement ratio. And if that wasn't enough, for those of you living in any of the following countries, Canada, the UK, New Zealand, Australia, Sweden, and Hong Kong, in your countries the reserve requirement is 0%. And it has been so for years. How is that going to limit any money creation? So, bank money creation is not limited by reserve requirements. But if it's not limited by reserve requirements, does this mean that banks can just create unlimited amounts of money? No, not quite. Yes, banks create money when they lend out money. But they are not the only party involved. They need their customers to demand for loans. Banks cannot lend if no one is willing to borrow. This could be an explanation of what is happening in much of the industrialized world. Even though central bankers are trying their hardest to motivate banks to lend more by lowering the interest rates or by buying out debt, lending has been slow to pick up. Not very surprising, since many of their customers are already to their necks in debt. Another reason why banks cannot keep on creating more and more money is that the law requires that they have a certain amount of their own capital to back up their loans. In many economies, this ratio is something like 7 to 8%. Like with reserve requirements, this does not, however, put a hard ceiling on the total amount of money banks can create. Why? Because banks can issue more capital, which the public can purchase. That being said, this does not really make it too difficult for banks to expand too rapidly, especially since multiple banks compete with each other. If one bank starts lending too much, its stock price might tank. Therefore, banks will often voluntarily hold liquid assets that are slightly above the required ratio. This also leads us to the third constraint on bank lending, and that is liquidity. Banks are also required to hold a certain percentage of their asset as any liquid asset. This includes cash, but also reserves and also short-term debt with other banks. And even if this wasn't required by law, people might start believing that a bank has expanded too quickly and will not be able to pay out the money they have there. Even in our modern day and age, bank runs still take place. Yes, the central bank will lend reserves or cash to these banks if they made sensible loans. But if they didn't, they can still fail. If that happens, small savers will get their money back from the central bank, but it can take up to half a year for the central bank to reimburse them. So, therefore, the threat of a bank run is still there. This limits the ability of banks to expand too quickly. Again, it's not a hard limit, but it is a limit nonetheless. So, that was that. Let's hope you're now cured from the money multiplier myth that is still being peddled by some outdated textbooks and YouTube videos. Let's say that's not entirely the case, you're not entirely convinced by everything that I've just said, then I've left some links with further readings for you down in the description of this video. Alright, but before you go to those readings, let's do a quick recap of this video. Yes, banks create money. No, this doesn't happen by taking your cash and then lending it out all over again until they reach the reserve requirement ratio. In fact, the reserve requirement ratio is not a hard limit on bank money creation. Why? Because central banks are willing to create new reserves for banks that are healthy but in need of cash. So, that does away with the reserve requirement limit. Does that mean that there are no limits to bank money creation? No, that's not the case. There are still limits. Remember, banks can still go bust. What are these limits? These were the public's demand for debt, these were capital requirements, and these were liquidity ratio. This has very important implications for all of you central bankers or armchair central bankers like me. If reserve requirements do not put a ceiling on bank money creation, how can the central bank hope to have any control over all of that money? That will be the topic of next week's video. If you're interested in central banking, finance, and macroeconomics, please consider subscribing to this channel. I'm currently thinking about doing a bi-weekly release schedule of new videos. Now, if enough people subscribe to this channel, I might be able to increase that number of videos. If you like the video, you can also really help me out by dropping a like, and if you're still in doubt on some aspects of this video, comment down below and I will actually go into the comment section myself and be there for discussions with you on the topics of bank money creation.